Today on the Financial Advisor Marketing Playbook, I'm joined by Josh Kneller of Atlas Capital Management. Josh works closely with independent financial advisors across the country, giving him a really unique perspective on both the investment management side and what it takes to build a growing advisory practice. We talk about how advisors should communicate with clients when markets are climbing, what clients really need to hear when volatility arrives, and how to navigate conversations when performance doesn't really match expectations. We also explore how market uncertainty can open the door to meaningful prospect conversations and what Josh sees the fastest growing advisors doing differently. Let's jump into my conversation with Josh.
This is the Financial Advisor Marketing Playbook, a show for financial advisors who want to explore the topic of client acquisition and business growth. Your host is Mark Mersman, Chief Marketing Officer at USA Financial. He is an investment advisor representative of securities offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor.
All right, welcome back to another episode of the Playbook. Today, I am joined by Mr. Josh Kneller of Atlas Capital. Josh, thanks for agreeing and letting me twist your arm into doing this. Appreciate you joining us.
Anytime I can assist. It's true.
So I got a lot of things I want to pick your brain on. And it's funny because I'd asked you to do this podcast a little while back, and then you were in our office recently and we're like, what are we even talking about? I don't even think you knew what the theme of the podcast was. So my apologies for that. But I knew I could get a nugget of wisdom or two out of you, believe it or not. So no pressure, my man. I want you to give a little background into your history. I think that's going to be helpful for people as we go through today's conversation. Give a little background on your history in the industry and where you're at. You're obviously with Atlas Capital. Kind of give the 30-second overview of your career in our world, and that I think will help lay the foundation for why I wanted to chat with you.
Okay. Happy to do so. Thank you for the opportunity. I started as a junior in college, getting my securities licenses, 6 and 63, bike insurance, all that stuff for an internship. Got the bug, got hooked on it, went to Wall Street for a while, and then in about 2000, left Wall Street to come to an RIA, Atlas Capital, and a different focus than what I was doing at that time. But I really believed that the future of the industry was managed money. So I've been here for 26 years now. So I have the luxury of talking from both sides of my mouth, from the BD world, the stock transaction world, the advisor world, but now more as the money manager world. So kind of been through that gauntlet, and really happy with where I ended 26 years ago. So.
Yeah, and I it's going to be an interesting story for you to share here in a bit, because I know a little of your history at Atlas and kind of the evolution of your company going from the retail into the institutional side. So I want you to touch on that. But since you've obviously been with Atlas now since 2000, you've seen .com bubble, you've seen the financial crisis, you've seen a bunch of different market cycles, right? What have those years kind of taught you about investor behavior and even advisor behavior during those periods of uncertainty and stretches?
Great question. From my opinion, investor and advisor behavior are highly correlated. They're both irrational at certain points. When real money is being lost in the stock market, people become emotional, and we have figured out a way to remove that emotion. There's nothing we do here. I'm a very emotional person outside of the office, but when it comes to money management, there's literally zero emotion. We find that advisors and clients, all clients, have figured out a way to impose their will or their opinion on what's happening. And in reality, remove that from the table. I think if you have a dedicated, proven way of doing things, little hitches, things of that nature are always going to be there. It's how you react. And in our case, We don't forecast. We are not that smart. I have never seen anybody say, I've never seen the title of a psychic winning a lottery ticket. It just doesn't happen. So we can control our reaction to the market, and that's what we do. And so from this standpoint, I find advisors get stuck chasing returns. They get frustrated. They don't have confidence in what they're doing. You cannot control the market. And as soon as you come to that realization, you can control your reaction to it. And when that time comes, I see the advisors, it's almost a paradigm shift to they're in control of their practice now when they come to that conclusion.
Yeah. And to be clear, I mean, you guys are on the institutional asset management side. You have kind of devoid yourselves of anything on the retail client side of things. But you do sit close to, the investment management process and what you guys do, as well as the advisors utilizing these strategies with their clients.
Right.
Where do you see kind of the challenge there? Because I think more and more advisors are outsourcing their asset management. Where do you see the biggest disconnect between what you as the portfolio manager is doing and what the client understands, in terms of the breakdown between your day-to-day actions, because you guys are looking at the market with everything that you do on a daily basis, right? And then the advisors trying to convey some of that to their client. Where do you see kind of that being lost in translation in the middle there?
Where there's a disconnect, and I don't know if it's a true loss. I find, and in my opinion, there are advisors that are over communicative to their client. I mean, daily, weekly, monthly. That is not what investing is. It's really not. Understanding a process and what you do over time. And I always talk, and you said something very important, and I need to back it up. You said cycles. If more advisors would talk about market cycles, I think they would have a heck of a lot better job of conveying to a client how good they're doing, how poor they're doing, the whole nuts and bolts. People that put their timeline on a month to date, quarter to date, 6 months to date, year to date, you're setting yourself up for failure, because no strategy, nothing,
Right.
and I mean this, works each and every time, unless you want to go buy a CD or you want to go buy money market or something like that. That is not what we do here. So I find that advisors do a very poor job. And this, again, my head better be on a swivel here. I find advisors do a poor job of managing expectations for themselves, but even more so for the client.
So as we sit here, I think it's a good segue too, because as we sit here in the middle of 2026, I mean, you look at the last decade plus of the market, and outside of a little blip there with COVID, it's been pretty good, right? And
really good.
When markets are performing well, I mean, how should because you hit on this. They're over communicative, right? Clients can, or advisors can be, but what's the best way for an advisor to communicate during these good markets? What conversations should they be having to reinforce their value? I mean, because you're probably going to see some clients look at their 401k and say, I don't need an advisor. I mean,
you're right.
What does that communication look like? What conversations should advisors be having with clients?
Everything you're saying right now, Mark, flows back to managing expectations. At the point of sale or throughout the lifespan of that client, whether it's in the incubation, I'm trying to sell you to, all the way to you've been a long-term client, you have to manage those expectations. And I find that during a roaring 9 out of 10 years up market, expectations are irrational. Right now,
right.
People understand the rule of 7 and 2, and they're saying, "Hey, I'm going to double my account every 5, 6, 7 years." It doesn't always work that way. It doesn't. So, what I'm saying is, now is the time for an advisor to go to a client and prime that pump and set the hook to say, "Hey, it's been really good. I know you've been looking at things. I know we're happy. We've done X, Y, and Z. I don't know what the future holds, but the strategies that we employ are ready to adapt to what the future holds. Nobody can predict it. If you're just going to buy something and hold it, you better be willing to take the losses, take the gains, do different things, do what the market does. If that is a problem for you and you need to have some type of exit strategy, some type of what I call a whoopee, a blanket to hold on to make you feel better, then we need to change our strategies and understand that what we're doing right now might not be positioned at all for any type of turbulent times downward ever. And you're maybe over allocated that way. We need to set that hook and also promise that client one thing. And advisors hate it when I say this. Promise them you're going to lose the client money. Just promise them. That's the one thing that you can deliver on that promise no matter what. It's going to happen. It might be for a day, a week, a month, etc. But if you can do that, that phone call when it comes in, when they just got hammered by the stock market, is real simple. Steve, Mr. Client, remember I promised you I was going to lose you money. I promised you. We just did it. Now there's a psychological thing there. You promised something and you delivered. Now, it might not have been what the client wanted, but it is the truth. And we're also in the industry, the only industry I know, that when things are on sale, nobody wants to buy. I mean, it's not. Hey, things are on sale. Oh, I want to wait, see if it gets better. Wait, you want to wait for the market to go up so you can pay full price? Yeah, I want to do that. Okay.
Yeah, I think. Anyway. I've heard you say that when you communicate with advisors. I promise you I will lose you money. And you've had rough stretches at times. I mean, to be very clear, Josh, your strategies have performed incredibly well. It's obviously the reason that you've gotten a lot of assets from the advisors we work with. And, if you don't work with us, I'd encourage you to connect with us and get to know Josh and his strategies. But you have always been, as much as you want to celebrate the wins, you have been very clear that we are going to lose you money. And I think that it stops people in their tracks a little bit when you make that promise, and it's almost laughable, right? It becomes kind of a laugh track that you can cue up that second you say it, there's like this little giggle in the room when you make that promise.
Mark, to add color to that, you're absolutely right. No matter how sophisticated the advisors are, no matter how sophisticated the broker dealer or firm is, when I speak to those types of reps in big settings, I say that right away. I promise I'm going to lose your money. And they all laugh. Why do you tell a client that? Because it's true. You need to tell them that. It's okay. They know it. I mean, they really do know it. But to me, one of the most important things that I think an advisor needs to understand, how little an investor loses during the bad times is a far better test than how much money they make in the good times. Because human psyche, if the market's down 30 and you're down 10, I'm really happy as a manager. We did a heck of a job. Now, what a client hears is you lost me 10%. I paid you to do it. And I don't like that. Well, put yourself in the real world, buddy, because that means I've got 20% more left for when the market gets rolling again to make more money. I'm going to get even a heck of a lot quicker, is what I'm trying to tell you. So I'm reducing volatility. Now, that's exactly what people want. They just don't say it.
Yeah. And there's that famous quote. I think it was a Warren Buffett quote, right? I don't know if it was, don't confuse a bull market for brains.
Correct.
And I think bull markets obviously can cause clients to become a little more aggressive. I think we see it with advisors sometimes where, they may even start comparing their results with their neighbors, with their friends, with indexes, right? And then they start chasing performance, or maybe they had a bad little stretch and they're going to chase performance. How should advisors respond when clients begin chasing performance? But there's kind of an underlying thing in there because we'll also see advisors do the same thing, right?
Correct.
So, what's the response there?
From my standpoint, I talk strategies, thought patterns. An investment strategy isn't worth much if you constantly change it due to lack of understanding or lack of confidence or comfort or whatever. I look at things and say, hey, give us time to do our job. A market cycle, by definition, I can quote it, or a 10% pullback. Well, I don't care. It's a couple good years, a couple bad years, a couple boring years thrown together in whatever order they come. And if we can consistently add value, there's two ways: reduce the amount of volatility and have more money at the end. That's what we do. That's what an advisor should be conveying to a client. I don't care that your neighbor bought a whole bunch of SpaceX. By the way, they're underwater right now. They might have made money if they traded it. I don't know. But I don't care. Advisors should look at a client and say, we don't know your neighbor's goals and objectives. Don't compare to them. What we're doing is your plan. This is what it's going to take for what you told me based on your answers to questions in your comfort zone to get you to the ends, to being there. It's like a train sitting on a track for a client. They know which way the train's going. But when you put that train on your timetable, meaning it's got to leave at this time, it can never stop, and all this stuff, you got a problem. You're setting yourself up for expectation. You cannot dictate the time of departure, the stops, etc. They get frustrated and they end up making foolish moves. They go do what their neighbor did. That's what they do.
Yeah. So, all right, let's talk a little about, and I'm sure you deal with this maybe once or twice a year, once or twice every other year. Strategy underperforms. Mm-hmm. And an advisor comes to you because a client came to them and said, hey, this isn't doing what I want it to do. What's the level of, what information do you encourage an advisor to, relay to that client? Is it charts? Is it graphs? What's the advice that you give to the advisor who had the client that's not happy because a certain strategy isn't doing well, wants to make a change? Where do you take them?
I'm maybe more open than most on that. I've set that expectation level on day one. Hey, I promise you we're going to lose you money. I promise there's going to be times where you're frustrated with what we're doing, and you probably ought to add more money at that time because it's on sale. That type of an attitude. But what I find is that if you are frustrated monthly and quarterly in comparing us to what we do, what index, or any investment, you probably are in the wrong investment, because you should go buy that index. I mean, that's the honest to God answer. If you are so frustrated and you have to do what the index does, why try to be better than it? Why try to, be worse than it? Go buy it. It's cheap. You don't need the advisor. What you need, it's kind of like an airplane. We all know airplanes fly themselves. We all know that airplanes land themselves. But I'm not getting on an airplane that doesn't have a pilot on it. I'm just not. Yep. Doesn't mean I'm scared of it, but there are a very finite amount of times where that pilot adds alpha, does something that changes and makes my ride better. Okay. And that's where a money manager comes in. If we cannot perform over a cycle, and I don't talk month to date, quarter to date, and year to date, unless I beat up on it. Yeah, year to date, I don't care where we are. I really don't. If your goals are year to date, next week's grocery money should not be in the stock market ever, then that's my opinion on it. So looking at it from a bigger perspective, I look at cycles. If we cannot add value over a cycle, you should fire us. As the advisor, you should say, hey, Mr. and Mrs. Client, Atlas isn't doing their job based on what's available. We need to move away from them. And that then brings on, throw us under a bus is what I'm telling the advisor to do. That way, that client's not looking for a new you. You keep the client.
Yeah.
Make sense?
Yeah. And we haven't necessarily had this happen recently, but when a client says, I can't afford to lose any more money, what questions should an advisor be asking before they start defending the portfolio or recommending a change?
I think this is a very that's a unique situation with that relationship between that advisor and client. How honest can you be with that client? How upfront?
Right.
If you haven't noticed from this 20 minutes or whatever, I'm brutally upfront on stuff. When I look at things like that, if a client tells you I absolutely cannot afford to lose any money, and what we do, and perhaps what that advisor is doing with that client, is not appropriate, because we cannot promise you that. I'm promising the opposite. I'm going to lose you money.
Right.
So we are not there. There are products and services and things out there that are there. But here's the good news. When that happens, Mark, that's capitulation. When people throw in the towel,
Right.
That's March 14th of 2001. This was the .com. That is typically the pain index, as I call it. When the pain is so great, I'm out. And I lived that life. And when did people, who's next? Where is that line? And typically, as that happens, you should be bailing. You should be buying if you believe in history. I believe that most equity-based strategies are not appropriate, even ones like ours that could go cash or go inverse, depending on the strategy, for a person who says, I cannot lose any money. We're not a good fit.
Yeah.
We're just not a good fit.
And I think it all does come back down to that initial setting of expectation. I love how you just promise right out of the gate, because most advisors, they're showing the performance of the perfect portfolio that is going to be doing this, right? And we all know that any of those proposals, there's not a chance in hell that the future is going to look exactly like what they just showed them. So it's irrelevant. But that's the crutch that a lot of advisors will lean on, versus the other side is a stark contrast. I mean, I think if an advisor started a seminar by saying, I have something I can guarantee you, if you work with us, I will lose you money. You're going to get some laughs, but you can break down that wall of.
You can close more business, Mark, because people look at you straight in the eye and say, okay, I like this guy. This guy, we all know that. I mean, we all know you're going to lose money. But why do guys tiptoe around it? I don't understand it. Why do you say, oh, your account is going to fluctuate and vacillate and use all these big 8 words? No, just say I'm going to lose your money. They know it. Here's the other thing that I would recommend to an advisor, new or old, no matter where the life cycle of the client is. I would paint your client into a corner, kind of with fun, and say, hey, if you look at your account right now, it's 1.2 million. You wake up 3 years from now, it's 2.4 million. You had a double over 3 years. Would you be happy? And the client says, yeah, I'd love that. That'd be great. But then I say, time out. A year and a half in, it was worth 5 million. And then we lost money that last year and a half, back down to there. I don't like it. Well, you can't answer both ways there. You told me you liked it, but then, but I masked all the volatility by giving you, beginning and end value. The ride is more important than the end value for most clients. Advisors don't, they look at that beginning and the end. They want the mountain chart, top right quadrant, go with it. It doesn't work that way. It can. You can get lucky. It's like the guy from, 82 to 99. No matter what he did, market went up. I mean, you'd buy anything during that time period. But that same guy from 00 to 08, that's 8 years that the market basically went up and down, but you're at the same level. And if you were just passive, didn't play defense, didn't do anything, just bought the index, you are even during that 8 years, at 9 years almost. So, and people get frustrated about that. The other thing that they forget that advisors need to reiterate is you lose time in the market. Those 9 years of doing nothing, going up and down, getting nowhere, spinning your wheels, that's tough, because most people really only have 30, 35 years of investing. And if you lose 9 years and get nowhere, that means you got to really hit the, right foot on the floor on those other years. And typically that means the opposite, you bring on more risk for most people. And, and now it's a self-perpetuating prophecy, is it good or bad? So anyway, I just encourage guys to look at things, and understanding expectations, but the ride and the emotion to the client is far more important to the client than it is to you, I believe. And you're more beginning and end value, compound annual growth rate.
I think that there's stretches of time, and we've been in one where, and I kind of asked this earlier, but I'm going to take it a little bit different way, but where the market's done well and clients can kind of sit back and say, my advisor's doing fine. So if I'm an advisor who wants to win that prospect, what's the conversation? They look at their account, it's growing fine. What do you say to an advisor to kind of win that client or that opportunity? Is it because I think the knee-jerk reaction for a lot of advisors is to try to come up with even a better portfolio based on, all the back testing or what the history of something. What's the opportunity to win? Like if you're coaching an advisor, here's a prospect who's kind of saying, I'm not unhappy with my advisor or my returns or what's going on, but something about, I'm talking to you so that that there's something there. What's your talk track?
There's a lot of different ways to go with this one. And I will tell you there's successes with each one. There are failures with each one. What I do is I look at the portfolio. The advisor brings and says, hey, what do you think? I don't look at 5-star funds, 4-star. I don't care about that stuff. I really don't. I look at it and say, how efficient is this? Is there a more efficient way to do it? How do I blow holes in it? What do I compliment them on? You should compliment the client. Hey, congratulations. I'm glad I'm glad you're happy, whatever. That works. It's true. Compliment them. And ask them, well, hey, what do you not like about it? Well, I don't like anything. It's perfect. Well, if it's perfect, why are we talking? That's the way I go at it. But the next part of that is, if I could show you a way to get a very similar or even better return without taking as much risk, would that be of interest? Wait, you can do the same thing? Yeah. Okay, well, let's talk about it. Let me just show you, and let me show you how I can maybe complement that portfolio. And once you get a part of it, and if you do your job right over time, you're going to get it all. I promise you. That's the way it works. So I tell guys, don't always go for the whole, don't go for the whole animal. Go for a portion of it. And let's say, hey, this part right here, I'm not overly thrilled about it. Here's why. I don't like how when the market did this, it did that, whatever it is, and be honest. And then get to a point, say, hey, I don't want to beat up on this. Congratulations. I think we could make some things better here. And why don't we take part of this and let's do it? And do not take half, whatever you do. Don't do half. Do 55-45. Do 60-40. I don't care. If you do 50-50, all that client's going to do is compare what you're doing to what that other advisor's doing. It's real easy math, whether you're sophisticated or not. And if you're winning, then you say, hey, how much money you want to move over to me? And he says, all of it. Great. You got the whole account. But if you're not winning, because whatever you're using is out of favor, for example, value out of favor when growth is going well, you've set yourself up for failure. And, make it hard for them to do the math, the 60-40. Everybody talks about their 401k. My 401k beat you guys this year. Well, how much money did you put in it? Oh, I put in $18,000 this year. Well, did you back that out? Oh, no. Well, you need to, because it works a little differently here. So anyway, I just believe if there's good things they're doing, compliment them. If they're not doing well, there are an obscene amount of horrible mutual funds. They're overpriced and they underdeliver. Other than that, they're great. It doesn't sound like what I want. So they're out there. Trust me. And your clients own them.
Yeah. What questions would you encourage an advisor to ask to really kind of help their prospect uncover how they actually experienced the last market decline? Not because, and I guess maybe I'll even back this up by saying, what's your take on risk tolerance questionnaires? Because I think that's a play that most advisors, that's the industry, right? That's what we've been taught. Risk tolerance questionnaire. You and I can joke about how is it even real? Because you're in the moment and you're going to fill it out one way when the market's up and fill it out a different way when the market's down. But how do you help a client uncover how they actually experienced the last market decline?
First of all, a lot of those clients have to remember when that was.
Right.
To play into your hand of a lot of strength. I believe, and for good or bad, that if an advisor, based on today being 2026, does not show you how 2008 was, then you should run. Because that's really the last big hit market. Now, I know COVID can be construed as that, but in reality, COVID was without being flippant, a very easy trade for most active managers, and a lot of money was made during that time. You can go back to when the U.S. got Moody's cut the debt from AAA down. That was a little bit there. If you were able to pivot to bonds, it made sense. But what I'm getting at is from a risk side, you need to paint that picture. You need to say, Mr. Client, there will be a time where you open up your quarterly statement and you are going to see that we lost money, serious money. And I mean big time dollars for whatever the reason, even your 401k. I want you to understand this happens, and I believe it will happen again. I would like to promise you something. It will happen again if you live long enough. But I don't hide that. And if you woke up right now at age 50 and you took a 50% haircut on your 401k, does that impact you? Maybe, maybe not, because you say, hey, I got another 15 years of working. That's fine. That's fine. But if you're 65 and you don't have time, remember that 9-year stretch we talked about, and you don't have money to do it, to put in at that time and buy on sale, you have a problem. So I guess what I'm trying to say a long way around it, I make sure an advisor understands and shows a client something like 08 or difficult times. And I actually recommend to all advisors, whether they utilize us or other firms, our competitors, we have great competitors, we have crappy competitors, there are good investments out there, that they talk to a client, because the most important thing to most clients is not that risk tolerance thing. That's and I'm going to get in trouble. That's more of a CYA for the advisor.
Yeah.
I mean that with respect, but the client is the emotional one. You need to understand and point them to, hey, let me show you the bad times. Anything works in good times. Everybody's really good. They're perfect. They're not. But having said that, it's how do you do in the bad times? And I said that earlier. I think, it's a great quote. I really believe how much a portfolio goes down relative to the market is a far better indicator of money management than how much they go up. Now, if you're really good, you don't go down as much and you go up the same or more. And kind of got a history of doing that. Is it perfect? No, not perfect. If I wish it was a straight line.
Yeah, right. You speak with independent advisors, across a lot of different business models, right?
Sure.
What are you seeing as the fastest growing practices? What are they doing differently from the rest?
It's a great question. Most independent advisors are kind of on an island. They're not. They don't have the bullpen atmosphere and getting to talk to people. So they're more. They spend more time doing some research and thinking than some of the other types of advisors out there, and I think that's helped them. It also gets way too many of them thinking way too hard about things. They overthink everything and try to bring things more simple. Try to have your pitch, your thought pattern, whether it's a white collar, blue collar, educated, not does it's moot to me. It's the same discussion. I don't have to throw out big words to look smart. Remember, I'm not that smart. I've never been the smartest guy in the room. I'm fine with that. So, but what the independent advisor is doing is relying on more back office assistance, meaning thought patterns, advanced planning teams, products that are niche in terms of what they can do for that client. And they're doing something that some of the bigger firms aren't, and it's self-serving for firms like ours. They have come to the conclusion that they are done as a quote unquote money manager. It's better to find managers that meet needs and goals and let them be more of the owner or general manager and not the coach, if that makes sense, making the decisions day to day on certain things, and they outsource it. And I hate that word, but I don't have a better one. And try to streamline and become more efficient, because their costs are going up, but fees as a percentage don't go up; they go down over time. So, but as AUM grows, that's how you're offset. So they need to have advisors that meet the goals, money managers that meet the goals of what needs to happen for that client. Period. So they're better at that.
You guys went through this evolution at Atlas. And when you kind of started that shift from retail to institutional to really kind of define who it was that you served and what was the right business model for you as a company.
Right.
Talk a little about that. Like what was that because I think that's an interesting history. And I'm not saying I don't want you to share this under the guise of every advisor should go and do this, but I think it's an important understanding of how you guys evolved your thought pattern and why your business model shifted.
Yeah, I know exactly where you're leading. I'm very open with this story for a lot of people. We were not geared to be a money manager, institutional, third party manager, TAMP, whatever you want to call us in today's world. When Atlas was started in 1999, was before I was here. It was started because at the time, one of the top producers, the founder of Atlas, top producers at a wirehouse, wanted to get into managed money and wanted to get away from the day-to-day transaction side. And that's at the time we in the early 00s, it was known as a wrap account, and not a lot of firms had a wrap account, a fee-based account. And the broker dealer used that. If you were a big time producer and you had no little black marks on your name, on your FINRA review or NASD review at that time, they would allow you to have an outside RIA and have a fee-based account, and did that. And part of the reason he did that was because he could play defense. He could exit the market. He could do things that weren't common at the time. And over a period of a few years, basically transitioned 100% of his book into that mentality, left the wirehouse, etc. I came on a year or two later and kind of did the same thing. And it was really for our clients. That's it. I mean, just like anybody. Long story short, 30 seconds or less, we stole some big clients from some other wirehouses. A couple of those advisors got mad at us because basically, quit stealing our clients. We said, hey, do what we do. And they said, we can't. And we said, we know. And over a period of time, we did that again. And finally, one of those firms called us and said, hey, we want you to stop stealing our clients. We want to sign an agreement with you guys where you guys manage money for our clients and you share part of your fees. Yep. We're like, wow, you want to give us distribution, and that's what it really meant. And let's figure this out. How do we do this? And so, as an SEC governed RIA, we, went to counsel and did all the stuff, and it's called a solicitor's agreement, and we learned how to do that over time. That was in early 2000s. Over the next 4 or 5 years, all of a sudden we have 30 or 40 selling agreements with more regional based broker dealer firms, etc., because it was a way to add value to an arrow in their quiver for their advisors to be able to offer managed money, and they didn't have to have an internal department doing it. Well, as you know, guys tend to switch firms and they move to another firm, and that selling agreement, we get a new one. And next thing you know, we're managing more money for other advisors than our own clients. And we stopped taking we stopped taking new clients. And, now 20 years later, we're at a point where we're on a platform or two, and then we still have solicitor roles. And there are a lot of firms that still do it that way. But so we never really need our end all client anymore. So, I mean, that's a quick version. We can get into more detail at a later date.
Yeah, no, I think it's helpful because you leaned into what you were good at and kind of went all in there. And I think there's a lot of advisors that struggle, that kind of wrestle with that dilemma of being an asset manager or an asset gatherer, and financial planner. And I guess you kind of pulled the plug on that and made your decision and never looked back.
Let me. I love interrupting you, by the way. Thank you. In all seriousness, that is a question that you should find in your role, I believe, a lot, or at least you guys should figure out with an advisor. Are you an asset manager, or are you an asset gatherer? I mean, it's not a hard question. Oh, I'm a little bit of both. You work twice as hard and you make half as much. That is and I believe wholeheartedly your client, your end all client, is not getting the service and the touchy feely that they need. Pick one, roll with it. I don't care which way you go. Right. What do you like better? Because if you can do different things, what your skill set is, you can make a lot of your community and a lot of your clients very happy and be well respected for what you do. My biggest fear is you get stretched too thin. You can't do both. You also bring on a huge conflict of interest. And I talk to broker dealers about this. Hey, they can do that. But the problem is, you said something earlier. What happens if you underperform? Well, what happens if you're the advisor? You're managing all the money. You're doing the client relationship. You sit down with the client and you say, hey, Mark, hey, we underperformed last year. We did a crappy job. Sorry. Right. We're working harder. We're going to do a better job. Well, the client says, okay, Mark, I like you. You're a good guy. You're a Michigan State fan. I'll look beyond that. So great. But the problem is that next year, when you sit down with that Mark and you underperform, or you are average at best, or you are not what the client expected, you can't fire yourself.
I mean, you don't. I was going to lose some money, Josh.
Well, yeah. Well, you didn't do that to start, though. No, but it's hard to fire yourself. Now, if you've outsourced that money manager, whether it's us or somebody else, and we're not cutting the mustard, you sit on the same side of the table as the client, and you say, "Hey, Mr. Client, we got to change things up. Not happy with this? Let's move on." And you don't lose the client. That is a huge thing. I find way too many guys. The other thing is they're handcuffed to their desk watching the tape all day long. They're not out finding new business. I mean, or they're working nights with new clients because, they want to trade that last 30 minutes of the day. Okay. Well, most advisors, that's not what they want. They don't want to be handcuffed to their desk.
Right.
So anyway,
what's one growth strategy, that you've seen an independent advisor use successfully that more advisors should consider, to grow their business? And I'm not saying on the money management side, and, I'm saying, you obviously talk with advisors all over on the country. Is there anything that has kind of caught your eye as things that you've seen an advisor do that's pretty clever, or that if I were going to start a practice tomorrow, I'd probably look to do some of that?
It's a great question. There are lots of guys that their successes come to mind because of very unique situations. Sometimes, being lucky, luck favors the well-prepared, if that makes sense.
Right.
And I really believe that. But what I found is that a rep who understands that clients view he or she one of three ways, always. I don't care if you're in the Northeast, Southwest, I don't care where you are. And end all clients view the rep one of three different ways. Now, you might be more than one. You're probably not all three. It's opportunity. If they view that advisor as an opportunity, a guy who brings good advice to the table, has connections, does this, recommends, hey, maybe you don't want to make a trust as your Benny in this. Does the opportunity stuff. If you can get your client to view you as an opportunity, you get a lot of clients and you get a lot of referrals, which people are hesitant to ask for referrals. Get over it. You got to in this industry. But if the client views you as an opportunity, you're going to get them. What you don't want is the client viewing you as irrelevant. That's the second of the three. If they view you as irrelevant, you have not done your job. You have not educated. You have not set them up to be successful. Third, a threat. Those are the three ways that clients view advisors, in my opinion. Opportunity, irrelevant, and a threat. A threat is a pure sales guy. The guy who comes in, met you 20 minutes ago and recommends you buy this. That's a threat to me. It might be the best thing to buy. It might be. But no. Clients need to understand it's a relationship, not a product-driven service. If you want a product-driven service, go online. They're not going to hold your hand. When 102 happens, 08 happens, 14, COVID, you're not going to see it. You're not going to see any help. You're not going to get. One of the other thing, one of my big pet peeves is, and I've seen this forever. A client says to the advisor, "Oh, Mark, well, you're going to watch this, right? And if I need to make a change, you're going to tell me, right?" And they shake their head up and down. As a sales guy, you're like, "Oh yeah, no, I'm not. No, I'm not." And that's where there's a disconnect.
And it's funny you say that, because I remember this early in my career when I first got my license and I started making my first sales. What I thought at first that a financial advisor was, even before I got in the business, I thought that we were watching the market, watching their accounts, and it became like this aha moment for me once I got my fourth or fifth client, and I was like, "Oh man, I can't possibly do that. If I keep getting all these clients, right. I can't possibly look at each of their individual accounts and say," but the clients, many of them think that's what the advisor is doing.
The advisor's set up for failure there. They really are. But a smart advisor can parlay that into something listen, I don't know how many annuity companies there are in today's world. I'm going to make up a number. I'm going to be light. I'm going to be heavy. I'm not going to be correct. 200. Well, as an advisor, you do not know the story of 200 different products. It's not out there. You find a niche, 2, 3, 4, 5 is a lot, different products that you understand. Parlay that into money management, 1, 2, 3, 4, 5 firms that you know what they're doing, how they're doing it, why, and all of your clients in some way, shape, or form own those types of things, and where you really need to know how 5 money managers are doing and 5 annuity contract or whatever, insert name here. That's what you do. And how do you manage risk then? Well, you figure out different wedges, different sizes to do different things. Do not become an expert on every product. As I said earlier, there are, I don't know, at one time, 35,000 mutual funds. And just do a quick little filter. How many of them have beaten their indice, their benchmark over a 10-year period of time? That 35,000 goes down to 1,000. I mean, that means there's a lot of crappy stuff out there. And people buy it every day. Trust me.
They do.
I mean, so you don't have to be perfect, but you have to be that opportunity. You need to say, hey, what we're doing here on the active side, let me tell you how we're doing stuff, when that client calls. So you at least know that. Now you're at a point where your knowledge is the same. It's just now you can apply that to an entire book of, 2,000 clients because they're all doing very similar things, just at different increments. They don't need to know they're doing very similar things, and they might not be exactly the same, but you understand it. And that's what I would recommend to a guy starting today. Don't just take the free lunch when a wholesaler calls or an somebody wants to do that. No, if it's not a good fit or it doesn't resonate well with you, if it doesn't resonate with you, how in the hell are you going to sell it to a client?
Yeah.
I mean, you're not that good.
Yeah.
Mark, you might be. I'm not.
You touched on something earlier. A client views you one of three ways. Opportunity is obviously the one that is the winner. I know this because you actually just had an intern for one of our advisors come through your office and spend a little time with you. He's in our office today. What's your advice for somebody that's young in the business like that on how to be viewed as an opportunity? And that's that's a tough ask, right?
Great question. And you're talking to a guy who started at 21. Me in this, I started before that in college, but really after college, without saying the name of a firm, I went around and door knocked houses to show them.
You don't need to say the name now.
Okay. And I had nothing negative to say about that firm. They were we had a different thought pattern. We believed in playing defense. They really didn't at the time. So anyway, I would use the youngness as a plus, not as a negative. Yep. Don't do it. Clients, no matter how, I would never hold a person's age against them on it. Experience is important and they have very limited. So, but guess what? They have mentors or people in this industry, back offices, front offices, colleagues, competitors. When I say competitor, I mean same firm, different shingle outside their office somewhere else that they can rely on to educate. And in this where I found that guys want to help. Age is not an issue. It's only a number, and it's only a problem if you make it one. Don't. Okay. This is the best time in the world to get into this industry. I would start again today with what I see. If I was 21 getting right out of school right now, would I do things differently? Oh yeah. But I learned from the failures. I did. I mean, I had 6 or 7 different ways that I was going to make money, these ways. And I divided my time evenly across that. Well, after a year, I realized that these 2 ways, which were generating 50% of my income, while these other 5 ways, which are taking a lot more time, let's redirect that time this way. Right. And that'll work. And it sounds real simple on paper, and it is, but it's hard to do. The advisor who is sitting there waiting for the phone to ring to call them to go buy something, you ain't going to make it, buddy. Don't sit there and wait. Get yourself out there. Be that opportunity. Be the opportunity. It will work, whether it's local community stuff, find a mentor. The other thing I would tell them, be honest with yourself. Do not lie to yourself about what you're doing. Oh, it's Friday at noon. I should go home. Nope. Don't do it. Work really hard those first few years. I promise you, you're going to be underpaid. You're going to be frustrated. You're going to have other buddies who are making more money than you. I promise you. It just happens. They got a W-2. They got a check every week. You might not. But then turn around and figure out that there is a break-even point somewhere. Move that break-even point as close to the start as possible by doing hard work. And then all of a sudden, you are welcomed with referrals. You are welcomed with income, for lack of a better term. And be that opportunity. You'll be fine. You got to get through the pain, though. You do. Yeah.
Imagine advisor is listening to this, realizes that maybe they haven't been proactive enough with clients or prospects in certain conversations. What's one conversation that they should initiate this week? If you were going to say to an advisor, look, you can pick up the phone and start a conversation with, these people will answer. We know that so-and-so clients will answer. What's a conversation you would encourage them to have?
that you haven't talked to these people in months type attitude?
Yeah, right. Yeah.
Yeah. Okay. I call them up and say, hey, you're getting ready to get you probably just got your quarterly statement, or it just went out. I mean, it's July 16th.
Yep.
You're going to get it. You're going to be really happy when you see it. Second quarter was really good. Now, I don't know about third quarter. We had some changes happen. You know what's happening with oil. You know, we're in a war. I just wanted to talk to you. I was thinking about you, looking at it, and you're going to open it up, and I think you're going to be happy. And I just thought I would give you that happy call today. Don't sell them anything. Don't even try to sell them anything. Now, if they say, hey, we were thinking about you, we need to talk. Great. When's a good time? You know, I mean, it's a quick, I had 10 minutes. You want to lie? I had 10 minutes before I go into a meeting. Even if that meeting is with the coffee machine, it's still a meeting. You're getting coffee. Hey, I had 10 minutes and I wanted to give you a call. I don't know if you opened your statement yet. Yeah. No, you didn't? Okay. Well, you might want to. You made some really good money this quarter. You should be really happy. I like what we're doing. I don't want to make any changes, but I wanted to make sure and get in front of you when I had some time here and tell me what your thoughts are, you know, and shut up and let them tell you.
Let's flip that and let's assume that the quarter was a bad quarter.
And you called them before they get that statement.
Okay.
You do. I mean, hey, okay, yeah, Mark, you're the client.
So you're going to try to be proactive. What's that? What is that talk track? How does that go differently?
Mark, it's Josh at Atlas. Want to give you a quick call. You're getting ready to get your statement. Have you gotten it yet? No. Okay. When you open it, you're going to be a little frustrated. This is one of those quarters where when I told you, remember I promised you we were going to lose you money. This is that quarter right now. I'm not worried about it. What we're doing is sound. Our investment strategy, we're not going to change it. Have your goals changed? No, but I just want you to see that, hey, I wanted to give you a heads up because what I don't want is you to get that statement and be shocked and give me a call without understanding it. I want you to understand I see it. Our managers did a good job. They didn't lose as much as the market, if that's true.
Right.
You know, if that's be brutally honest, those are the calls that are the opportunity calls, because you will be shocked at how many times that call preempts a discussion that generates revenue for you,
right?
Or creates a referral for you. Oh yeah, you know, I knew it was bad. Well, yeah, we're in a war. You know, you listen. Your money is made being a communicator and being an opportunity to that client, to the point that they refer to you, and I've seen this, as their external CFO, their family CFO. And that's kind of what you are.
Yep.
So anyway, I don't hide it. Don't be what I used to call a sleepy broker. We don't use the term broker anymore. Sleepy broker. I used to pick on sleepy brokers all the time. Oh, you got your statement, you know.
Yeah.
I bet you weren't very happy. Well, no. Well, did Steve call you? No. Well, we need to talk about it. Okay. You know, that's the door that's open. Be the opportunity.
Yeah.
So anyway.
All right. Let me hit you with some rapid fire questions here, buddy.
Okay.
Your favorite business book and why?
Business book and why. Two of them. Atlas Shrugged is my favorite business book. I don't know if you know it. It's by Ayn Rand, How Our Firm Was Named. Who is John Galt? If you don't know who that means, read the book. If you want a copy of the book, I'll get it for you. You got to get through a couple hundred pages that are really boring, though.
That's one of the bigger books out there, Josh. Yes. Don't tell me you read that all the way through.
Absolutely. I absolutely. Change some names, change some typewriter to computer, change some things in there, and it's very pertinent in today's world. I'll just put it that way. And it was written in, I think, 52 or 54. I mean, a long time ago. Second one, Rhinoceros Success. The exact opposite. You go from novel to, bathroom reader book? Type thing. What's that?
Okay. Is this a cartoon book?
Rhinoceros Success. It's really geared for a young person starting in the industry. Basically, you're a rhino, not a cow, and you don't go to the herd mentality. You got tough skin. You're not pretty looking. I don't look like a Kennedy. I got it. I know that. But you know, it's really good book on how to take with rejection. And now the younger population today doesn't do that because they don't do this. They do this. And they've never been told no face to face. And so they need to, that's a great book. I don't know, it's 40, 50, 60 pages, and it's a half size book. I mean, it's perfect for a guy like me. So, okay, next question. Let's get to
best piece of advice you've ever received.
Oh boy. So there's a lot. And best piece of advice in life in general?
Yeah.
Marry that girl.
I'll take life.
Marry that girl. My dad said, marry that girl.
Okay.
That's the best piece of advice I've ever taken. And I was already going to do it. I knew that. I was going to do everything in my power to do that. But from a career standpoint, don't worry about what others are doing. Don't worry about your buddies. Worry about you. And if you can do what you do very well, you will be just fine. Trust me. And I believe that.
Your favorite quote or something that you find yourself kind of sharing with people often.
Mark Twain had a quote. There are three types of lies in this world, right? Lies, damned lies, and statistics. Those are the three types of lies. I can show you pretty charts that show how great we are. I can hide an elephant on some of those charts if you just give me point A and point B and don't worry about the inside. So that's statistics. Be careful with statistics. Just because you've highly optimized something so well that it's perfect, it's not.
Yeah.
It's not. I mean, it'd be like driving a Formula One car around your local town. That car is perfect for what it does. It cannot handle a pothole. Yeah. It cannot handle snow. It cannot handle, X, Y, Z. It's a perfect car. And that's where people over optimize stuff, trying to get what they think is out there. Clients need opportunity, they need communication, and they need relative. They need to be able to outperform what they're trying to do. The difference between being up 25% and up 23%. Yeah, I know it's 2%, but the market's up 10. Is either client happy? Yeah, they're both really, really happy. So why are we robbing people? If we can earn the 23 with taking 2/3 of the risk of the 25, maybe that makes sense. Anyway, that's overanalyzing it.
If you weren't in the financial industry, what would you be doing?
I always had interest as a kid all the way up into my early 20s, played baseball and all that stuff. Never was going to be a pro baseball player. I knew that. But I always loved graphic art. So I always thought this was really cool. Now, thank goodness I'm not in that industry at my age now, in my 50s, because I wouldn't be good at it. But secondly, AI is completely cannibalizing some of those graphic arts, which is something you should have asked. That's a poor job on your part, AI. No, I'm serious. I get that from a lot of firms. And how do we use AI? And you said some successful stuff for firms, for advisors, AI, not for money management, but for content media, for communication. There's a lot of ways to streamline your business that can do things far better than what your skill set is.
Yeah. How are you using AI?
Mostly on the marketing side for advisors. I still believe I'm a stalwart to the yellow pad and shaking hands. I enjoy. There's sales guys for Atlas that can go out and do stuff, but I enjoy going to the broker dealers, the firms, etc., as a presence with my face and thanking guys for business. I still do handwritten cards to guys. I know that sounds really old, and that's okay. I don't always do it, depending on the situation, but I believe in that opportunity. I believe in relationship.
You haven't sent me a card, Josh.
Well, mail's slow in Michigan, I guess. Hang on, let me make a note. No, I'm kidding.
All right, last one. If you could master one random skill instantly, what would it be?
I'd like to be a better communicator. I think that would be really, in all facets of life. I think I'm a good communicator, but I think communication is really the key to life. I really do. From a family life, from a professional life, from relationship life, buddy relationship type thing. I'd like to increase my communication. Now, in reality, one thing, if I could really do it was, and I'm going to try really hard. I just don't know when I'm going to hit that time. I'm going to get back in pre-college shape. And for me, that's a big deal because I got kids that are athletes and a wife that is crazy athletic, and I need to get back into that type thing. It's hard. I can get over that, but I just haven't pulled that trigger yet. So you can get on me about that. I would appreciate some feedback, so you can beat up on me.
Oh, you just opened a door, my friend.
I know. And you know what? But that's what a relationship is.
Yeah,
it is. That's the communication part. Guys, I would tell every advisor, you better be a better communicator than your competition. You better.
Yeah, no doubt.
So,
all right. Somebody's hearing this and says, I kind of like that guy, and maybe we want to learn a little bit more about what they're doing. Where do you want them to go? How do you want them to seek you out?
Well, it's not meant to be a commercial for us.
No,
that's not really what this was. It was, hey, I need, but either the go through you, get a hold of you, let you get your meat hooks in them right away to move over to you guys. Or they can go to atlascapitalmanagement.com and then go to our website and you can go through all that. Love to introduce what we do. If it fits, great. We have selling agreements with lots of firms. We don't have them with them all. And we won't. But, I stand ready to assist. I really view myself as a partner and my team here with the advisors out there. And I be the opportunity to them. Everybody here will be that opportunity to you to assist you on stuff, even if it's not stuff we make money on. Okay. We're not an FMO. We don't do any of that stuff. I know a lot about them. I can, get you pushed out to the right places. So you can go to atlascapitalmanagement.com. You can find out how to email us there. You can always call our 800 number. You just tell them who you are and you're looking to talk to me. And unlike we actually have people that answer the phone still. We actually have incoming calls. It's weird. So anyway, that's really it. If it's more of one of your advisors, obviously they know how to get a hold of us.
Yep. Awesome. Hey, I appreciate the time, Josh. I knew that it wouldn't be short. It's hard for me to give you the hook when you're speaking at anything that we're doing. So
no, it's not.
The beauty of this format is I don't have a time constraint, so I can let you talk. Sadly, I know that we could knock down another hour or two if we could go Joe Rogan style if we really wanted to, but we don't need to bore everybody. So,
Mark, I appreciate the time, and I am serious on those thoughts are mine. They're not. They don't have to be right. Advisors don't have to agree with them. But I found that whether you are new or old, independent or captive, no matter where you fit into those space, I think something that we discussed, the two of us, will resonate with somebody. And if it's a little carrot that either saves you a client, which is it's a lot easier to keep clients than it is to find new ones in some market cycles. Congratulations, I'm happy for you. Our goal. You asked me my favorite quote. I told you Lies, Damn Lies, and Statistics by Mark Twain. My favorite quote is one that I get $1 every time somebody says it. My goal at Atlas is to be mostly right most of the time. That's it. Nothing more. And that's my quote. It's really, it makes sense. Clients like to hear that because they know it. They know it. So anyway, that's that next hour, part 2.
All right. Well, I'll have you back. We'll come back and circle back on this. So, all right, brother. Good seeing you and appreciate your time.
Yeah. Hey, buddy. Wish you guys all the best. And if I can be a resource, let me know. Okay.
You got it.
This information is for licensed financial professionals only and is not intended for use in soliciting sales from the public. The views expressed represent the opinions of the presenter or their featured guest, not necessarily those of USA Financial or its affiliated subsidiaries. Industry references are generic and are not intended to represent actions or beliefs of any individual or entity. Content is only presented to illustrate general principles, beliefs, or ideas and should not be construed as legal or regulatory advice. Trademark and copyright protected. USA Financial and Affiliates.